Affirm reported quarterly financial results that disappointed stock market investors, and the stock price fell by over 14% on the day following the release. Of course, I was disappointed in that because I've had Affirm stock rated as a buy all year long here in 2025. I last updated this stock around March 15th, March 17th, where I rated the stock as a buy when it was trading at around $45 a share. It's now at around $46 a share. It gave up most of the gains since the last recommendation. Still, year to date, the stock price is down to $45 and $46.41 in the aftermarket hours. It has underperformed overall. I'm going to review the company's latest quarterly earnings results, update my proprietary discounted cash flow valuation model, and let you know if I still think this stock is a buy following the earnings release.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so some of the highlights from the company's third quarter 2025 operating results were that the gross merchandise volume grew by 36% to 8.6 billion, and growth accelerated as we exited the quarter, with gross merchandise volume in March increasing by 40%, which was surprising to me because that's when we saw the increasing volatility in the market following the tariffs that President Donald Trump placed on the U.S. trading partners. The general merchandise and consumer electronic categories again contributed significantly to growth. These categories, consumer electronics especially, contain high-priced items where consumers are more interested in using Affirm's buy now, pay later option. Direct-to-consumer GMV increased 50% to 2.4 billion, and Affirm card GMV within this quarter increased by 115% to 807 million. The growth rates for card and D2C overall accelerated from the prior quarter. So far, we're seeing a lot of positives, and you might be wondering, why did the stock price fall? Well, something the company also included that's not shared on this screen is that the default rates are increasing among the customers that it allowed credit to. And given what I mentioned earlier, there is elevated risks of recession. And if a firm is already seeing increasing default rates, especially with its older cohorts, those that it started lending money to or giving credit to in 2022, their default rates are rising. And then those customers that it gave credit to in 2023, they're seeing their default rates rising. And so default rates are increasing with the older cohorts. The customers that stay with Affirm longer, their default rates seem to increase over time, which is a concerning trend that I noticed with Affirm in this most recent quarterly update. The positives were plenty as well. Active cardholder count more than doubled to 1.9 million active cardholders as the card attach rate continued to increase. Overall, active customers, excluding the discontinued Returnly business, increased by 23% to 22 million as of March 31st. And this is really the positive virtuous cycle starting to increase and snowball. This is the business model that I really like to see in this segment with companies like Affirm, PayPal, Visa, MasterCard. They generate an increasing snowball as they increase their two-sided customer counts. So active customers increased by 23%, and then active merchants also increased by 23% to 358,000. Annual growth in active merchant count exceeded 20% for the third consecutive quarter. So these increases on both sides of their equation really fuel the company's growth. As more consumers want to use Affirm, that's going to attract more merchants to accept Affirm as a payment method, as an option for buy now, pay later. As more merchants accept and offer this service, more consumers are going to want to sign up, and that positive virtuous cycle can continue feeding on itself up to hundreds of millions of active customers, perhaps billions of active customers. If you're comparing Affirm to PayPal, PayPal has over 430 million active customers. If you compare Affirm to, let's say, Visa, which is a little bit unfair because Visa's much, much larger, many more decades in business, but Visa has over 4 billion cards outstanding. So the potential is massive here for Affirm. As long as they keep feeding this virtuous cycle, adding value to merchants and consumers, and the proposition is beneficial for both sides. Customers like it because they are impatient. They get to buy things before they have the money saved up to buy them. Merchants like it because customers buy things before they have the money to buy them, meaning it facilitates sales. If a consumer was not able to buy now, pay later, they may not buy that product at all. And so merchants like it because it generates sales. It makes their products appear more affordable by breaking down the purchase price over several payments. So now let's look at valuation. And I updated my intrinsic value calculation for Affirm. I now calculate these shares to be worth $62.46 each. The current market price is $46.41. So even accounting for a margin of safety, this stock looks undervalued at the current valuations according to my DCF model. I'm not going to go through breaking down each step, but if you want better breakdowns, more detailed breakdowns of these proprietary discounted cash flow valuations I've created, you could join my channel as a member. I've got dozens and dozens of videos doing these detailed breakdowns of discounted cash flow valuations, as well as other member exclusive videos. It's less than $5 a month. I think it's a great deal. I also like to look at valuation, measuring it on a forward price to earnings basis. And my preferred data source is finchat.io, and there's a link in the description for a discount. The forward price to earnings is at 28.6, which I think is cheap for the prospects and the growth opportunity this business has over the long term. So I mentioned that I last updated Affirm stock on March 17th, 2025, when I rated the stock as a buy, and this price decline has it back to where the price was when I first recommended the stock as a buy in March. But the company does face higher risks than it did back in March, given the elevated geopolitical tension, given the risks of recession have increased, given the company's default rates have increased. Still, I like the company's long-term prospects. I like the value proposition for both consumers and merchants. And so I'm reiterating this buy recommendation for Affirm stock. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.